All right, so whether you are a first-time home buyer or a seasoned homeowner, there are many costs to factor in when you're shopping for a home. There's inspection costs, appraisal fees, title fees, escrow costs, earnest money, moving expenses, and of course, we can't forget closing costs. But there is one other cost, one other expense I did not mention. And this one may be the most important when trying to decide just how much money you can spend on your home, and that is your down payment. Your down payment plays an important role when you're buying a home, yet sometimes can get overlooked when thinking about all of your other expenses throughout the home buying process. So let's start at the very beginning. What is a down payment? A down payment is a portion of your home's purchase price that you pay up front when you close on your home loan. Simply put, a down payment is a portion of the cost of the home that you pay up front. It represents your initial investment in the home. When you put more money down, you are taking some of the risk away from the lender, proof that you are invested in the purchase, and a sign that you are committed to making all of your mortgage payments. In return, your lender may offer you a lower mortgage interest rate. Now, when it comes to your down payment, there tends to be some common down payment myths and misconceptions. And today, I want to discuss the pros and cons of both a smaller and larger down payment, as well as what roles those down payment options play throughout the mortgage process. All right, so let's start with one of the biggest misconceptions regarding down payments. And I hear this one a lot. John, I can't afford a home. Everyone keeps telling me I have to put 20% down in order to get this home. Is that correct? This is actually not true. In fact, the median down payment for first-time home buyers in 2021 was just 6%, according to the National Association of Realtors. 6%. It's quite a bit of difference from 20%. Now, of course, assuming you can do it, putting more money down certainly has its advantages, but it's not necessary. For some, putting a large down payment comes with plenty of perks, but it's not necessarily the best decision for everyone. Let's discuss the pros and cons. All right, so what are some of the benefits to putting less than 20% down as part of your down payment? Number one, it saves you time. The first benefit to a smaller down payment is very simple. It saves you your time. Waiting to save up 20% for a down payment may cost too much time. While you are saving for your down payment and paying rent, the price of your future home may go up. So while you might be tempted to keep saving up money in an effort to make a bigger down payment, this strategy could actually backfire. What added up to 20% down payment on a typical home in early 2020 is much smaller percentage today in many of the markets across the country due to record high home prices. So putting less than 20% down might be worth it to get into the home that you want to get into and start building valuable equity. Number two, pay off your debts. Another benefit would be pocketing that extra money you didn't have to spend on your down payment, and instead begin paying off any high-interest credit cards or related debts. There are very little positives to paying 25 to 30% every month on interest on your credit cards. Trust me, pay those off. It will pay off in the long run. Number three, keep your savings account. Another big drawback to a larger down payment is that you could stretch your savings too thin and leave yourself scrambling for emergency funds if you were ever to need them. Think of it this way. If you are draining nearly all of your savings to make a bigger down payment, you are putting yourself in a tough position as a homeowner. What happens if you need to cover an emergency cost, such as buying a new car or fixing an issue on your new home in the next 6 months? Okay, so we know the positives behind a smaller down payment. What are the benefits to a larger down payment? Number one, smaller monthly payments. Making a bigger payment up front translates to smaller monthly payments each month. We all like to pay a little less each month, don't we? Number two, lower interest charges over the life of the loan. Those smaller monthly payments add up to significant savings in the long run. Think of it this way. If you put more money down, you owe less on the overall purchase of the home. And this means you are borrowing less money. And less money means less interest over the life of the loan. Number three, potentially better terms. Lenders like to see larger down payments. By putting more of your own money into the transaction, you are borrowing less of theirs, which also can put you in the running for the lowest rates possible. Number four, ditch the PMI. If your down payment is 20% on a conventional loan, you won't have to deal with the additional monthly fee of mortgage insurance. If your down payment is lower than 20%, on the other hand, your loan to value ratio for conventional financing will be higher than 80%. And in this case, your lender may require you to pay private mortgage insurance, aka PMI, because they are lending you more of their money to purchase the home and increasing their potential risk of loss if the loan should go into default. Keep in mind that PMI will increase your monthly payments. So what does all of this mean for you? When you consider how much to put down on your home, think about your lender's requirements and what a higher or lower down payment will mean for you. If you're having trouble saving for a down payment, you should know that certain lenders participate in programs that could enable you to qualify for down payment assistance. Ask your lender whether you might qualify for one of these programs. I'll catch you guys next time.